Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and economics and finance with our lens through our Bloomberg Intelligence analysts. They cover 2,000 companies and about 130 industries worldwide. We also take a look at all the stock market action, taking a look at Nvidia. That stock up by still over 9%. That company, Paul, that's some serious cash. I mean, that just like mints the money.
It does. And, it's just extraordinary. You think about kind of how they've become really the play on all things AI. I mean, it was a year ago, maybe 5 quarters ago, that they issued that revenue guide increase that just shocked the tech space and shocked Wall Street in terms of, wow, this AI spending thing, it is real. Because we are seeing, Nvidia is seeing it in its order book, and it's just been extraordinary. And it hasn't let up. And, I talked to Tim Stenovec every time these company reports earnings, and he asked me, Paul, do you think these guys are going to beat and raise? And I said, I think so, until they don't, because I just don't see any end there. At least what you hear from the companies that are making these orders, like Microsoft, like Amazon, all they talk about is AI.
Exactly.
And they get the chips from Nvidia. So there you go.
I mean, so yes, more than 40% of Nvidia's revenue comes from just those guys, right? Microsoft, Meta, Amazon, Alphabet. Okay, so there's some maybe risk in that. You have competitors that are still trying to ramp up their own ability for that. So I guess you're looking at, again, what I like to talk about is a structural versus cyclical trend. The AI is here to stay. It's a structural change, a structural trend, right? Doesn't mean that eventually this also won't be some kind of cyclical story, but we're clearly not there yet.
No, and so when we get the smart people on, and we're going to get a smart person on soon, as soon as he figures out how to get his microphone all kind
He's
of
smart in
figured
other
out.
ways.
Yeah. Is competition. I mean, you're supposed to be on air at a certain time with the mic. How hard is that? So the question is, competition. Where's competition?
Yeah. Well, it's hard. It's expensive to get this stuff out. I think that's the problem.
And also, if you don't want to pay over $1,000 this year for Nvidia, even though you're optimistic about the future there, what are the derivative plays there? I was doing
There's
this
so many.
small business report today, looking at a company that's not publicly traded, Encharge, the brainchild of a Princeton professor, to make it more energy efficient, these chips.
So, sure.
There you go.
Well, yeah, but there are a ton of those startups, but it's just a question of actually making the money. That is the question. All right, thanks so much for, I don't know why I'm thanking John Tucker.
We always thank John Tucker.
We do, but I'm going to go to someone who knows
welcome.
more about this. You're welcome. Kunjan Sobhani is Bloomberg Intelligence Senior Semi-Analyst. I hope he knows more than we do about this.
He does. He's smart.
All right, the stock up 10%. Can they continue at this point to just continue to beat and raise?
I think in the near term, they can definitely. Demand on most of their products keep running ahead of supply. We don't see any slowing down in terms of purchasing from their customers. In fact, beyond their largest cloud customer, enterprise and consumer internet companies are coming in strong. So we don't see any sort of big risk that says they cannot continue.
So Kunjan, I was telling Alix and John, when we get smart people on like yourself, I like to ask the question about competition. I'm kind of surprised that, Nvidia has this competitive leadership position relative to everybody else. How proprietary is their chip design versus, I don't know, the AMDs of the world, even a Cisco? What is the competitive landscape?
Yeah, I mean, look, they were, I would say, almost 2 to even arguably 3 years ahead of everyone. And it's not easy in the chip landscape to catch up when someone has that kind of a lead. They have actually aggressively gone out and out-innovate their peers. Before they were on a 18 to 24-month product cycle. Now they are on a 12-month product cycle. So they just keep staying ahead of their competition. Their competition is trying to catch up. AMD has made significant progress and now is another second viable alternative in the market. Hence, you see that in their significant growth as well. But we don't think at this point there is anyone else who can rival the total system TCO and performance that they have.
I was mentioning earlier that Nvidia gets about 40% of its revenue from the big 4 players, Microsoft, Meta, Alphabet, and Amazon. What kind of risk is that, if any?
I mean, there have been concerns around it. So there's two good data points that came out of this print. One, that concentration did reduce for the very first time. And what we liked, it was not reduced because the cloud guys slowed their purchasing. In fact, those top 4 guys are expected to increase their CapEx spend by 45% this year. Wow. And they're all lined up to purchase its newest Blackwell products. But what was good was that the share was taken by strong enterprise demand, which we really like because that is much more diversified and sticky.
Kunjan, let's say I'm at Amazon and I buy one of Nvidia's chips. When do I have to replace it?
Good question.
There's 2 answers to it. If we were in a normal sector semiconductor cycle, like you are in smartphones or PCs, the refresh time would be longer. So I would say ideally 3 to 5 years. But what's going on right now is all of these customers are just racing against each other. So they cannot afford to stop. So as soon as a newer, better chip is available that they can change, they are going to change.
What would stop all this? Like, we know that AI is going to grow. We know that there will be demand for chips. We know all that. That's a structural shift within the economy. But what makes it cyclical?
I think the first point of cyclicality would be when the demand momentum stops, which we haven't seen no signs of. Look, the supply keeps on coming up. So at some point, demand is going to be meeting supply. And after that, if we see any kind of weakness in demand, look, if the largest cloud providers don't see return on their investment, don't see monetization benefit, don't see their earnings and revenue grow from these investments, that's when we can start worrying about sort of a cyclical downturn.
All right, so how else in your universe of semiconductors, how else do you play this trend?
Look, Nvidia still remains sort of the best pure play AI play in semiconductors. So I don't know why you would want to look elsewhere. But if you were forced to, we also like players like Broadcom and Marvell when it comes to AI networking. When it comes to the ASIC chips, which Nvidia's largest customers are designing themselves. So these are the 2 areas where we see significant growth coming in over the next 2 years.
All right, Kunjan Sobhani, thanks so much for joining us there. Kunjan Sobhani, senior analyst covering the semiconductor space for Bloomberg Intelligence, joining us from San Francisco. He's right there in Silicon Valley.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's switch gears. Let's get right to our next guest, Shana Sissel, President and CEO of Banríon Capital Management, joining us from Chicago via this Zoom thing. Shana, thanks so much for joining us here. I mean, I guess the story of the day this morning is Nvidia, another beat and raise, as the kids say. What did you take away from the earnings last night?
It wasn't the earnings that I was most surprised by. I think we all expected them to beat. It was somewhat built into the stock price. Aftermarket, it didn't move that much. Obviously now it is. But I think that the thing that shocked me most was the 10-for-1 stock split announcement. That surprised me. Not because it's not unusual for a company to want to split in a way that would make their stock price under $100 again and make them more attractive to retail investors, make it easier for their employees to take advantage of their stock compensation and a variety of other reasons. But in the world of fractional shares, it's not as necessary, which is why we see so many stocks trading at, $500, $600, $700, $8,000. I mean, Chipotle is like over $3,000. So that actually surprised me the most. But the earnings weren't particularly surprising. Obviously, it was above consensus estimates, but there was a whisper number, and the numbers that they reported were close to that whisper number. And so, I think the real problem here is how long they keep doing this. This is the 3rd straight quarter that they've reported greater than 200% year-over-year revenue growth.
Yeah, and I feel like we've been asking that question for the 3rd straight quarter, too, so you're not alone. I was really struck by a note that came out today. Man, it's time for spring break. NVIDIA's done. We got nothing going on until June 7th, which is Jobs Day. It is time for spring break. Do you subscribe to that view?
I don't. I'm always following the markets. There's always interesting things going on. Obviously, as you said, the next big report is in June, but there's opportunities for here to take a breather. But I think this is a great opportunity to start looking for new opportunities to get into stocks as people are taking a breather. And so I use this time to kind of do my work and figure out what my best ideas are going to be going forward.
Shanna, do your best ideas include small cap stocks?
So right now, small caps have some technical issues. They have, I think they're in the third longest streak of negative, not reaching a new high. And they have really struggled to get out of the funk that they're in, which is unusual in many ways. And it might be a reflection of some change in market dynamics, especially the concentration in the large caps that Mag 7 kind of feel and what's driving it. But small caps are interesting because if you look at the data, it's the actively managed and the factor-based small cap types of ETFs and mutual funds that are outperforming, and substantially so. So this whole idea that active management is dead and that you don't need active management in your portfolio in order to do well, I think needs to be reconsidered, because in a place like small caps where there's a lot of inefficiencies and opportunities for smart money and those who are actually doing work on individual names to outperform, I think that, we should reconsider ways that we build portfolios, and active management right now is really working in the small cap space.
So where in the small cap space is it sector specific? Is it balance sheet specific? Is it a growth value kind of thing?
It's more factor based, so like quality, but even it has to be even higher quality, because the active managers are beating the S&P 600, which tends to be higher in quality than the Russell 2000, which tends to be full of a lot of like junk and penny stocks and things of that nature. So we're seeing that in active management. We're seeing it in the quality factor, you're seeing it in the momentum factor, but you're seeing it more in the factors than in like growth value and more than style per se.
Hey, Shanna, what are you guys doing in fixed income? I mean, I can sit in a 2-year treasury and get close to 5% here with no risk. Do I sit there or do I go out on the credit curve a little bit?
So we, being focused on alternatives, we're looking more at the private credit and private debt markets, some interesting opportunities in real estate income. And with the advent of interval funds, it allows us the opportunity to gain exposure to those types of credits, even for clients that aren't qualified or accredited. So, there's a Pender Capital has a real estate debt fund that is an interval fund that allows for the average investor to gain exposure to an area in private credit that was not traditionally available to that space. And there's others like that. So for us, that's kind of where we're playing, because that's where the real opportunity lies. Rates are kind of volatile right now, and as you said, you can get really good yield in treasuries. But we're seeing a lot of demand in the non-traditional credit markets and the non-bank lenders because the credit markets after the financial crisis kind of seized up for a lot of potential businesses, small business and such. So the private debt markets have real opportunity to get above average yield with relatively good credit.
Before we let you go, when you look at alternatives like that also include like gold, and I say that because, man, gold has been on a tear. Like, is that part of the portfolio?
Oh, absolutely. Commodities are part of the portfolio. Gold and copper are really interesting right now. Gold hit all-time highs yesterday. I would also put crypto in that space. So Bitcoin, and there's a lot of chatter right now about the probabilities of the spot ETH ETF being approved this week or next week. I know your colleague Eric Balkunas has been writing a lot about it. So it's one of those things where crypto is also quite interesting right here. But yeah, those are all alternatives, and those are all things we consider for portfolios.
All right. Thanks a lot. Really appreciate it. Thank you for jumping on with us. Shana Sissel joining us, President and CEO of Banríon Capital Management, joining us from Chicago, Illinois.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
We're also keeping our eye on the broader market as well. You're looking at the S&P is barely higher, up 0.1%. The NASDAQ, shocker, is outperforming, up by 0.6%, really helped by Nvidia at a record high, 52-week high, blowing past 1,000. So let's get, what I'm interested in now is now what? It's not only what's now what for Nvidia, but now what for the broader market? Is tech still going to be responsible for pushing it higher? Gina Martin Adams, Chief Equity Strategist at Bloomberg Intelligence, joins us now. And Gina, this comes directly from your guys' note this morning that came out that talked about the importance of tech when it comes to earnings, but how much that importance will still be there in the coming quarters.
Yeah, I think it's a critical issue for the market at large because we've been in this really intriguing sort of environment over the course of the last year where tech has sort of almost single-handedly held up S&P 500 earnings. Tech and communications together as sectors have been the earnings stalwarts in the index, while the rest of the index has suffered through some kind of earnings recession. In particular, the commodity-centric sectors really posting very strong declines, but also healthcare posting double-digit declines in earnings over the course of the last year. As we move forward, this sort of onus on technology should lighten up at the very least. And that may get reflected in the stocks as well. Naturally, when these were the only earners on the index, capital concentrated in those names, concentrated in those themes. And we're already starting to see some evidence that that thematic trade, that tech-centric trade is breaking up. Some of the evidence that we presented in the note this morning, for example, first is Nvidia isn't even the top theme stock that we follow right now. And when we look at all the stocks that are most levered to themes, the stock that has actually performed the best is Siemens Energy. We're seeing physical environment themes generally outperform AI-centric themes already in 2024. Earnings trends are shifting and correlations with the market between tech and the rest of the market are also shifting somewhat. So there's a lot of evidence that this is already occurring in anticipation of that earnings trend shift later this year.
How about valuation? Gina, where are we here kind of post-earnings? And we've seen the shakeout in kind of earnings estimates and guidance and so on and so forth. What does that mean for you in terms of valuation of this market?
Yeah, I think you have to look at valuations on a sector-by-sector, stock-by-stock, industry-by-industry basis. If you're looking at valuations of the market at large right now, you're also looking at valuations that reflect an earnings recession outside of tech and an expected slow recovery from that recession. You're also looking at valuations that are abnormally skewed toward tech. And tech is the one sector in the index where we can prove that using valuations as a tactical timing measure is a faulty strategy. So I do think that if you're looking at broad market valuations, you're kind of missing the bigger picture in really unique circumstances. So we do look at sector level valuations. And what you find is there are still quite a few very discounted segments of the US equity market outside of tech and communications, where again, capital has concentrated because those were the only earnings growth stories largely in the market over the course of the last year. So when we look across the landscape of the S&P 500, we actually see nearly half of the stocks in the index are trading at levels below their median valuation multiples of the last cycle, the pre-pandemic cycle. So that's just one small stat on what's really happening beneath the headline of multiples. Sure, everyone will tell you the S&P 500 looks expensive. It looks expensive relative to recent past because of these unique earnings circumstances, as well as the unique concentration of earnings inside tech and tech specifically.
And that's what happens when we say things like, maybe this time is different. Like maybe the economy is different this time than it was, say, 20 years ago. Gina, one of my favorite stories of this year has been the outperformance of utilities. And typically if that happens, you're like, ooh, well, investors are going to be really scared because that's where you go and you're scared and you want higher yield and you don't want to have any growth, et cetera. Is there a possibility for utilities to become a growth sector as we tie that into the data center AI story?
I think no.
No, but is there anything to that at all?
I think the reason utilities have outperformed is actually several-fold. Yes, there is some optimism with respect to AI, but we're in the process actually of working through our earnings sentiment analysis right now, and no utilities companies are mentioning AI as a growth opportunity for them. So as much as the market has maybe tried to push this narrative, that's really only part of what's impacted the utility stocks. It's important to keep in mind that utilities are very low beta stocks, We did go through a pretty significant corrective process in the month of April. Utilities naturally outperformed that process, so their base was higher coming into May. And then we've had a bond market rally. To boot, utilities are a high rate sensitivity sort of segment of the market. When bond yields rally, then of course utilities tend to outperform. So there's three reasons why utilities have done well over the last 3 months. I do think that there's a possibility, certainly, that you have some exposure to AI propelling demand for utilities. The question then is how much of that demand ultimately results in pricing power for utilities. And this is a really critical question for this segment. This is a hyper-regulated sector, especially here in the United States. Will they ultimately just get price pass-through on a regulated basis? Or will we actually see real shift in growth in the business model? I don't know, but it seems like the short-term answer is not anytime soon.
All right, Gina, thank you so much for joining us. As always, Gina Martin Adams, U.S. strategist for all the equity stuff for Bloomberg Intelligence. She does it all. We appreciate getting some of her time.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Staying on the auto kind of theme here, Joel Levington joins us here. He covers, he's the director of credit research for Bloomberg Intelligence. He does it all. One of the research areas he covers is the automobile industry. And Joel, thanks so much for joining us here in studio. You guys are going to have a conference next week in New York City focusing on the auto business. Tell us about that. What are you guys doing?
Sure, Paul. Thank you so much for having us. It's going to be a great conference next Thursday. Everybody, please come out to 120 Park for the show. We're going to be talking about things like auto loans and how delinquencies, which are as high as they were in the Great Depression, the Great Recession, where are they headed, and what does it mean that when Tesla cuts its prices by 35%? What does it mean for your residual values and your ability to buy a new car with the average price at $48,000? And of course, we'll have the rating agencies there. We'll have valuation views from JP Morgan, from Merrill Lynch, and from credit sites. So it should be a great afternoon for everybody.
First of all, I want to point out, he brought me swag.
Oh, let's see.
In the radio studio. It is a hat, Autopalooza 2024, Bloomberg Intelligence on the back. I love me swag. For those of you on radio, sorry, but for those of you on YouTube, you can check out my good swag. The problem is that I look terrible in hats.
No, you look great.
Yeah, no, trust me. This is a joke in my family that I can't wear hats. But my husband looks great in hats. Why are delinquencies so bad right now?
Sure. Well, 25% of loans right now, Alix, cost $1,000 or more a month. And so if you're thinking about your average consumer that makes about $65,000, that's your average household, a $48,000 car with a $1,000 plus loan, and then, like 18% of the loans that are outstanding, Paul, have a negative $6,200 equity value because prices, particularly for EVs, have been coming down so much. So it really puts you in a spot where you're paying for something that is already underwater. So why continue tends to be the question. And I think that's the key reason why you're starting to see seeing these numbers rise, despite unemployment levels that are quite low.
So what's the feeling in the auto industry, Joel, about kind of where we are in this transition to EVs? We seem to have hit a little bit of a bump in the road here, and I'm not sure if it's just a little pothole or if it's something much bigger. What are the companies saying? What are the investors that you talk to? What are they saying?
To me, I think it's actually much bigger than what people think. I think you're going to see more R&D and CapEx being cut and reduced. And I think you're really seeing a recycling of capital usage, where you're investing in EVs into an unknown project with unknown returns, whereas when your stocks trade at 3 or 4 times PE, why not go buy the shares or give more dividends? And I think you're seeing this shift in capital allocation from CapEx and growth from EVs because most consumers don't want them, right? The BI survey after survey tells you around the globe that people are not that interested in owning EVs.
Are they not interested in owning EVs because of the cost? Politically, they don't like this whole green energy thing. They're just not good vehicles. Why don't they want them?
Cost is a huge factor. At the beginning, when you have people that will buy whatever the latest and greatest technology is, that's great. and they can afford that. But a $120,000 EV Mercedes is not going to work for the average person like myself. And so you have issues there with price, which is what Tesla's been trying to do to solve that, right? And that creates different sorts of issues. I think the other thing is infrastructure. There's just not enough. And if you think about your typical consumer, perhaps in the Midwest, they go on long trips and they want 300, 400, 500 miles of guaranteed road, and you just can't get that with the infrastructure that you have today.
And is this just also sort of the wrong time? Like if we just pair that with auto delinquencies, we haven't seen this since the Great Recession. Like that's not the right time to then try and convince people to buy a car whose base price is $60,000.
Especially because you can get into something better like a hybrid, or better than a pure
better
ICE
value, or like cheaper and still does the same thing
and
relatively.
From a green standpoint, certainly better than a pure ICE engine where you could probably double your mileage, pay a lower dollar amount, and feel like you're doing something for the for the earth. And so I think that's really why you're starting to see a huge ramp up in hybrid sales across the platforms.
Can I ask a really dumb question about Teslas? So I've been using a lot of Teslas to get into the office. Like Uber has a green car thing. What I've noticed is like the size looks exactly the same, but inside I feel like I'm in a hotel room. It's like huge. Is that because Elon Musk takes out all the stuff that's in a regular internal combustion engine car?
The design and the compactness of their battery has done a tremendous job, much like Lucid has. Lucid, of course, was founded by the former designer for Tesla. So they've done a great job of like redesigning the insides of a vehicle. And that's why it feels so much more roomier than you get, because the battery essentially is pushed lower and the trunk or the frunk is pushed forward. So you get more space, and they also have more of a curved dome on the roof.
Have you been in one? Like,
yes.
Have you noticed that it feels so much bigger?
Now that you think about it, But I mean, I drove thanks to Matt Miller, the Ford F-150 Lightning, the electric version of that, and that was awesome.
Yeah, you liked that.
And I'm not a pickup truck driver because I'm an investment banker. I don't do that.
You don't do that stuff.
And I don't do electric. But boy, it was an awesome car, awesome vehicle. So what's the feeling, Joel? Is hybrids going to be kind of where we settle out, do you think? Or like I asked the BCG guys,
right?
And the auto guy there says he thinks in 10 years, 40% of sales will be EVs. Does that sound reasonable?
I would take the under on that.
Take the under on that. Okay.
Yeah, and I think it doesn't really help. It really doesn't help anybody until the technology is stronger and the cost is lower on the battery side to really make an effective car at an effective price. And I think you'll be seeing that ramp up in part because the Chinese are coming, and the Chinese can make a profit at $10,000 a car.
Well, they're not coming now because don't we have like tariffs on them and something like that?
We do, and that is a huge concern, really more for the Europeans than for the U.S. Ford and GM don't make a lot of money in China, but when you think about Volkswagen, or you think about Mercedes or BMW, that's about a third or 35% of their business is based in China. So it's really the tariffs that are going back and forth or being discussed between China and Europe and China. That's really where the sticking point is going to be in the near term for these autos.
So going back to the Autopalooza that you're going to have, and you have rating agencies there, it sounds very cool. Rating agencies and cool, maybe not usually is what you say, but nevertheless. What is going to be your forecast? Like, what kind of forecast are you looking at for the charge-offs, for the delinquencies? How are you thinking about that for the medium term?
Yeah, well, I think what's really going to be great there is Cox Automotive and Experian are going to be coming in and talking about what electrification means for finance companies. I know that doesn't particularly sound cool, but really you have seen perfect performance or near perfect performance out of electric cars. And at least the slides that they've shown me tell me that is not the case any longer. And in fact, it's going to be a lot worse than ICE engines. And so people that were betting on EVs holding their residual values, I think are going to be in for a bad surprise, whether it's the finance companies or people that own ABS securities that have a lot of EVs in them. So I think they'll be able to provide a lot of detail next Thursday.
All right, Joel, thank you so much for joining us. Joel Levington, he runs all the credit research for Bloomberg Intelligence, also covers the auto industry in his spare time. Autopalooza, get the auto industry together in New York City for a Bloomberg Intelligence Investor Conference Thursday, 120 Park Avenue next Thursday.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is a perfect time to check in with Matt Miller, the exceedingly overworked Matt Miller, who joins us here in our Bloomberg studio here.
That's some shade.
Matt,
sarcasm is the lowest form of wit, Paul.
Exactly. All right, what do you guys? I mean, you've got your you are so into this auto gig. You've got a podcast with our good friend Hannah Elliott. Tell us about it.
Yeah, and we have some amazing guests. So you're just talking to Michael Barr. He has a podcast, The Business of Sports.
Yes, he does.
And this weekend is one of the most iconic races in motorsports history.
Charlotte Motor Speedway?
The Indy 500. The Indy 500 is
I
coming
even
up
kind of knew that.
this weekend. So a lot of people are getting their RVs, driving out to Indianapolis. And Hannah and I spoke with Catherine Legg, who is going to be one of the drivers. She had an amazing qualifying session a couple of days ago. She was doing an average speed of 230 miles per hour, and she hit the wall. But she did not take her foot off the gas pedal. Never lift.
Is that right?
One of my favorite automotive phrases. So she's on the podcast this week, and it's really interesting. But we have an amazing lineup of guests coming up. Next week, we're going to talk with Zach Brown, who's the team principal for McLaren in Formula One. One of the most watched sporting leagues in the world.
So people tell me.
And then the week after that, I just snagged Tom Wagner. He runs Nighthead Capital. So everyone knows they own Hertz, and they had the whole Tesla thing. But they also own Singer, which is a Porsche customizer, I guess you could say. A Porsche resto mod outfit in LA that's very famous. You can pick one of those up for about $1 million if you wait long enough. And they also own Revology, which does replicas or reproductions, they prefer, of the 1968 Mustang down in Florida. They have a licensing deal with Ford, and they do an entirely new vehicle from the frame up, but it looks exactly like a 1968 Mustang.
That's
just
cool.
with modern day performance. Yeah. So an amazing business. He also owns a soccer team, so I guess Tom Keane would care. Like Birmingham, I think. I don't know. And a couple of world racing teams. Yeah, so I'm pretty excited about Hot Pursuit right now. We have a pretty good lineup.
Good.
That sounds really fun.
Do you ever listen?
Yeah. No.
Nice.
Okay, what was the last topic? Oh, she doesn't listen.
It was cars. Duh.
All I know is I follow Hannah
Hannah
Elliott on social, and what a life she leads. She's all over the globe,
Yeah,
literally.
Today she's at Lake Como.
Perfect. Why wouldn't you be?
In Italy, right? For the Villa d'Este, some kind of concours d'elegance.
Why didn't you get that gig?
Well, Hannah's much better at it. You know, she prefers like the high-end luxury market, the supercars and hypercars. Right. She knows all the millionaires and billionaires that do the collections. I like a Dodge muscle car or a Chevy truck, you know? I'm more salt of the earth when it comes to my...
So it's like a perfect combination.
Exactly. Well, we span the whole gamut, and we often disagree, but we have a lot of respect for each other, so... It's
for good podcast.
Yeah, sure. Okay, I'll listen. So, what are you driving right now?
I actually last week I was in the Fiat 500, the tiny little compact car, the electric version of that. It's actually pretty roomy on the interior, and I enjoyed driving it. I mean, it's not the right vehicle unless you're only going to go like maximum 5 or 10 miles, right? Because it's a tiny little sort of city car, but it really, really cool. And all the ladies in my hometown loved it. And this week I'm gonna test drive the new Mercedes E-Class, the 450. So it's got the inline 6. I'm pretty excited about that. But I'm most excited about the Mustangs that are coming up. I've been promised by Ford that I'm gonna get to drive the new Mustang Dark Horse, and I'm so pumped to try that out. Are you?
No, he's not talking to us.
Is he? I see John Tucker like whispering
No, he's not talking to
into
you.
his
He's not
microphone.
talking to you.
Oh, okay, no. So the Mustang, they came out with the new Mustang last year. It's kind of a beefier, brawnier, more muscular shape, and it's the last of the big muscle cars. They finished making the Dodge Challenger last year. They don't make that anymore.
Which you own.
I bought one. I bought one of the last call versions. Yeah, the RT. Scat Pack wide body.
See, I knew that.
And they finished making the Camaro. So GM and Chrysler, Dodge, or whatever you want to call it, they're out
of the muscle car business.
Mustang is the only American sort of muscle car you can buy anymore.
This seems like they made a mistake, because I don't think those muscle cars are going away. I don't think EVs are going to take over the world like we thought as recently as a year ago.
Yeah, I think they did it a little bit too early. They closed down production a little too early. But you still have...
Can you have like hybrid muscle cars?
No, that's not really like the point. The point of a muscle car is kind of a small, cheap vehicle, rear-wheel drive, big motor, and like dumb. Analog is the point of a muscle car, right?
But if we're going to keep the muscle car like over the next 60, 80 years...
Yes. So that is what Dodge is trying to do. They're trying to make electric or hybrid versions of... They haven't come out with it yet, but the Challenger and the Charger. So they do want that, but the muscle car... fans
might not want that.
The buyers of these products are very averse to electric. Like anything EV, if you go on the forums, they don't like. On the other hand, Ferrari is just about to open up its first all-electric factory. So, okay, they're not muscle car makers, but,
again,
typically...
that's not going to sell. I just don't see it.
Where's the sound? That's the sound that you love at a Ferrari.
I'm with you. I was just... Alix, I think, is on the right track. That's what they don't have any other choice, right? Because of the CAFE regulations, they can't make a 6.4-liter naturally aspirated V8 anymore. It's just too polluting. So they're trying to do anything else they can. The problem is that the market just isn't there yet.
Can I ask a quick Tesla question? Is Elon Musk focused on selling cars or doing the autonomous driving?
I mean, you'd have to ask Elon Musk.
The answer is yes. And space and battery storage.
Yeah,
no,
exactly.
It's like they're not focusing on the number of cars that they're selling now. He seems to be really committed to autonomous driving at this point.
Until it moves again.
Yeah, he's focused on so many different things, right? And a lot of investors are concerned that he's not as focused as he should be on their specific thing.
So, like Volkswagen, Ford, as in the last 3 years, they've made big announcements, big investments in EV,
and billions of dollars of losses.
Billions of dollars of losses. We've seen Ford pull back. I mean, we've seen a lot of the companies pull back, right, and say we're going to go this.
Yeah, I think they just lost too much money. They've obviously been regulated into and socially cajoled towards this EV thing, and they've all made the big bet that can't be unmade. Like, it's too late to turn around. They're all headed towards EVs, but they do have the ability to take their foot off the accelerator in terms of how many straight 100% BEVs they make and head more towards hybrids, because that's what the consumer wants. The consumer wants the hybrid. You can drive around town, electric power only, emitting 0 CO2 from your tailpipe, but when you need to go on a longer trip, the range extending internal combustion engine kicks in, and you don't have to wait at broken chargers to get more power. So I think they're all pivoting back towards hybrids, but yeah, they've already sunk so much into the battery power, the electrification, the software. They can't turn back around. And
so here's also my question, talking about the nuts and the bolts of the stuff, and this is where it gets to my world. So when you have these tariffs on things that you need to build those cars on China, but the price to buy them in North America is so much higher, what are these guys going to do? Are they going to pay 30% more to get graphite from Canada, or are they just going to wait for China to import that graphite to Mexico, and then they're going to get it for a lot cheaper?
First of all, I don't know the answer, but I would guess that at some point the government is going to have to step in and help, because
I agree with you.
The administration has regulated them into this path. They have no other choice.
Yeah.
On the other hand, consumers can't afford to pay, $45,000 for an electric car when the ICE equivalent is $25,000. Yeah. They've got the $7,500 credit, but you're going to have to either give more. I mean, especially if you've got these protectionist tariffs that are going to drive prices even higher. They've already caused so much inflation, and they're going to continue to inflate prices at the government level. So the consumer, if it's going to be able to keep up, is going to have to get a little bit more help from Uncle Sam. That means all of us are going to have to pay even more taxes than we already do. And
plus, John Tucker has to play the congestion pricing to come into Midtown Manhattan,
which is a
I
tax.
Don't know no, if I were Tucker, I would definitely charge that to work. Like, he comes in here at midnight, at 2 o'clock in the morning.
We keep telling him
his commute has to be subsidized.
We keep telling him this.
Yeah,
exactly. You're not alone.
I don't know why you murder yourself. You know, I mean, we all love our bosses, but
all right. Matt Miller, thanks so much. He's got the podcast. He does everything for Bloomberg Radio and TV.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.